Welcome back to Fresh Outlook, everybody. Just when the U.S. economy seems like it is back on terra firma, along comes a recession in China that hits America hard. Wall Street is off to its worst start ever. The Dow's 5.2% plunge in the first 4 days of trading in 2016 is a record breaker. Let's say hello to the Fresh Outlook guests who are with me right now. Albert Golson of Indo-Brazilian Associates, Jim McCarthy of Directional Wealth Management, Brian Dolan, Head Market Strategist of Drive Wealth, and joining us live from our DC connection is Jim Pearce, Director of Portfolio Strategy for Investing Daily. Jim Pearce, I'll start with you. You're up in the monitor. This could be a bad time, but this could be a time of opportunity for a lot of investors, particularly in the energy sector. It seems like many stocks are beaten down. Is it a good time to get on board?
Well, for certain stocks in the sector, you've got the exploration and production companies that, quite frankly, it still may be too soon. But some of the midstream companies probably oversold. And certainly there's even some refiners out there that have been taking a beating, even though this should actually be good news for them. So I actually right now do have a couple of energy stocks that I'm recommending in our portfolio.
Are you overall bearish or bullish about 2016?
For the energy sector?
For the entire market.
Or just,
for the entire stock market.
Well, for the stock market overall, I think the first half, right, so what I'm telling our clients, I think the first half of the year, we're going to have negative returns in all the major indexes. I do think in the second half of the year, we'll have positive returns greater than that. We're looking by the end of this year for a net gain of maybe 5 to 8% in the S&P 500 and the Dow Jones Industrial Average. So, but it's going to get off. I mean, this start, isn't random. There's a good reason why it's gotten off such a bad start. We've got the first, year-end and quarterly earnings coming out starting next week, and that's certainly going to add additional pressure on the market. By the time we get past June, July, I think the second half of the year, they will be pretty good.
All right, let's turn to our man who's got a look at the global perspective, Albert Golson. What's happening in China, and why is it impacting us so strongly over here?
The interesting thing about the China stock market is there's a big disconnect with the performance of the Chinese stock market versus the actual economy. You have to keep in mind that when China was going gangbusters a couple of decades ago, their stock market was relatively flat, and their stock market is fairly new. It's only about 25, 26 years old. Then when their economy started to cool down, it's probably a natural process, then the stock market started to go back up. So the stock market, Chinese stock market is being used as pretty much a lightning rod for China's overall economic issues, which basically they're experiencing a correction, which is relatively natural for this sort of economic growth, which was unsustainable.
Have we created a bubble, Brian? Is that what it is? We have such low interest rates that drove a lot of money to Wall Street. The average person, if they want any return on investment, they have to go to Wall Street or the bond market. Is this a man-made creation?
Certainly in China. And just to pick off where Albert left off, this is still the unwinding of the Chinese bubble. Okay, you have to remember that 85% of the participants in the Chinese stock market are retail investors with very little experience. In addition to that, they borrowed on margin and very low margin rates, and they borrowed money to put up for the margin. Okay, so that's part of the reason that this is happening. They put in some circuit breakers, if you will, or some restrictions on selling back in the late summer, and that's what has postponed this current sell-off. So if you look back to June, middle of June, it's exactly 6 months to the day almost when those restrictions expire, and they started selling in advance of that. So that's happening in China. In terms of other markets, I don't think we're necessarily looking at bubbles in other markets, but is this man-made? It's certainly central bank manufactured by the low level of interest rates. My saying is, Tina, there is no alternative to stocks. Okay, if you want some kind of a return, it's the only place you can go, and that's the reason that the stock markets and emerging markets in China have become such a strong focus of attention.
Jim, what are you telling your clients?
Well, basically, I think the U.S. economy is on reasonably stable footing. My expectation for the S&P 500 is a broad proxy for the stock market is somewhere in the low single-digit returns. Now, this was last Sunday before I woke up in the China stock market, but I don't think I've really changed that. Last year, people need to remember, last year between January 5th and January 6th of 2015, the S&P dropped 2.5%. So this is a steeper drop. Yes, it's the biggest first week drop in the history of, or at least back to the 1920s.
Right.
But it's not unprecedented by any stretch.
Particularly when you have a Dow Jones Industrial Average that's trading at over 17,000.
Exactly, and if you look at a chart pattern, and I'm not a technical analyst, but I do follow it a little bit, and if you look at a chart pattern, I mean, January looks very much like January did last year. We had a big drop in January, and then we rose to all-time highs in June. Then we had August, and then again October, which was fueled by the China stock market and the concern over it. So I think that that's part of it. I keep telling my clients they need to remember that China is the second largest economy in the world, and it's growing. Although I believe that most statistics now indicate that India will actually outpass us and become second. China will be first. We'll be third. Believe
Just
it or
by
not.
the sheer volume.
Just
of
by
people.
sheer by the growth of the population and everything else. But what China's in the process of doing is switching from a manufacturing economy to a consumer-based economy, much more like the U.S. So two things are happening there. One, in the U.S., our GDP, gross domestic product per capita, is around $50,000 per person. In China, it's only $15,000. So they've got a long way to go. But that's their goal. That's what they're trying to achieve. And part of the problem is you've got a lot of people that are moving up from poverty, real poverty. I mean, they've got poverty like we don't even know poverty. But they're moving up into lower middle class. They're jumping into things like the stock market, so they're fueling these bubbles. What was the China stock market up before this thing started to correct last year? Like 150% between 2014 and 2015. Mm-hmm. So while it's been a big fall, it's been a big fall from a pretty high peak.
Yes.
So,
Brian, can you trust the Chinese markets? Are they manipulated like everything else in China? Is it like getting your news from a state-run news agency in China, or buying baby formula in China and finding out it's half plaster?
The easy answer is yes.
You can't trust Chinese markets.
No, you cannot.
Okay.
Your assumptions, I think, are correct. We have significant doubts about the credibility of the data. None of it adds up between the provincial and state levels and the national government. So there's a lot of fudging of numbers that goes on. In terms of what's happening in the stock market, there again, it's as you mentioned, not only is the citizenry up and coming and new to money and new to moving into the middle class, the government and the policymakers, they're also new to managing the second largest economy in the world and markets. And that's why they messed up with the imposition of these very narrow circuit breaker bans that led to more volatility and defeated their efforts. So they're learning and growing as well. The Chinese stock market is only 25 years old. We can look back, if we look back on how the U.S. markets, the Dow Jones, Wall Street was functioning in the first 25 years, we had as many bubbles and blow-ups as China is experiencing as well.
Okay, so it's kind of growing pains. Let's turn to Jim Pearce. Jim, as you look for the upcoming business week that's going to start on Monday, what will you be reporting on? What will be the major stories of the week, do you think?
Yeah, well, of course, everybody's holding their breath for Monday's opening. You know, I think a lot of investors now are probably going to very much go into the risk-off mode. That doesn't necessarily mean selling what they have, but putting some kind of hedge or some other type of safety net under their portfolios. I do expect, though, to see momentum stocks coming under a lot of pressure. You know, it was over a year ago, I guess, the Fed discontinued quantitative easing. But I think at this point, we're going to really go into a two-tier market, and I think this favors value stocks and punishes momentum stocks. So I think the story that's going to start emerging next week is it's not going to be so much capitulation with people just selling across the board, but a more selective selling where they're getting rid of things already trading at very high multiples to future earnings and things like that.
Albert, it seems as though a lot hasn't changed since 2008. Yes, our U.S. numbers are better, but you've got a weak Russia right now, a struggling China, it appears right now. The Eurozone countries that were hurting are still hurting. They say our unemployment numbers are unrealistic because it doesn't count the people who have dropped out of the workforce and who are working part-time. So the fundamentals are still pretty bad with this global economy.
Well, there are a lot of areas that are going through transition. As my colleagues have mentioned, China is making a transition more towards a service economy from a manufacturing economy. So they have a heck of a lot of growing pains going on there. And then you have quite a bit of political instability in different parts of the world. For example, in Russia, as far as the sanctions are concerned. There's a lot of pressure on them to do things that they normally wouldn't do. You have Iran that will be coming online soon if the nuclear deal is finally agreed to be able to sell a significant amount of oil onto the market. That will certainly affect oil and energy prices across the board. And then you have quite a number of failed states in North Africa and Sub-Saharan Africa that's really causing a lot of problems in that area. It's drawing a lot of expenses from, let's say, Saudi Arabia, the United States, militarily to stabilize the region. So there are a lot of things that are going on simultaneously in which it's very difficult to predict exactly what's going to be happening in even the next 6 months or so.
Jim McCarthy, the Fed rate hike was basically just a gesture because it was a quarter of a point. Mm-hmm. Are more gestures like these coming, or do you think because the economy seems to be cooling off a little bit that we might not see another rate hike the next time Janet Yellen comes out to talk?
Probably not the next time. My note to my clients at the beginning of the year was I expected somewhere between 2 and 4, which basically leaves you with 3. I think it'll probably be on the lower end of that range, given that they have some momentum in the U.S. economy, but we are being impacted from these external factors, whether it's oil or it's China's slowdown. Those tend to impact a segment of our economy, mostly the manufacturing and the materials sector, which isn't really in the service economy. So the John Deere's, the Caterpillars, those kinds of companies, that in those industries, the oil and gas industry clearly is having an impact. But those industries make up around 7% of our total economy. So it's not going to have, I mean, unless they could cool us off if they went too far too fast. That is clearly one of the risks that I indicated, is if the Fed steps on the brake too hard or too fast. I'm expecting slow pumping of the brakes, if you will. So maybe 2 over the next year or so would be what I would anticipate.
Brian, eventually, will these lower fuel prices actually help fuel the economy because consumers will have more money in their pockets to spend, businesses will have less of an outlay for their fleets and so forth? So will there be an upside to all this?
Definitely. I'm looking at that. We're already seeing it in the incoming data. The most recent data is showing signs of increased consumer spending of that, or increased disposable spending of that gas surplus. And lower oil prices, while very bad for the energy sector and the oil producers, are great for the consumer disposable companies, great for consumers in general. And so I'm not expecting oil prices to go up anytime soon. And I think we have more room on the downside. So that's what I'm looking at as one of the underlying supports for the U.S. and the global economy as we look at 2016.
And people are buying SUVs again, buying trucks
low
again,
oil prices.
Not afraid to spend money because it doesn't cost $50 or $100 to fill up your car. That's a big thing. Jim Pearce joining us from D.C. I'm going to give you our final word on this topic. What do you think the average investor at home should know right now? What's your best bit of advice?
Right, and in fact, our clientele pretty much is the so-called average investor. What we're telling them is, as I said earlier, we do expect the market to continue to drop some, but we don't think this will be a crash or even a major correction. So not to panic and sell, but to selectively buy, and in fact, use this as an opportunity to buy large cap value stocks.
Okay. Jim Pearce, thank you so much for that advice to our viewers at home. And everybody's got some skin in this game nowadays, because whether you're in your 401k or in your pension fund, the entire economy is tied to the stock market. So it's not just the fat cats who are losing right now. When we come back, a look at a political issue that moved our still-at president to tears. More on that